D2, I want you to talk about the second part. If I go back to 2008 crisis, it exposed a lot of things in the system, credit bubble and mortgage bubble, housing bubble, all of that. But there were certain events which triggered an Armageddon or an apocalypse. Resilience or fragility of the financial system can trigger events which frankly get overstated in the economy context. So for example, we saw a mutual fund have difficulty in the end of March and therefore took recourse to some very extreme measures. We've seen that in November 2008 in India, right? You spoke about bankers are naturally conservative. I was tempted to say yes till I realized what yes means, right? So I can, when I look at the resilience of the financial markets, is that could be a trigger of an event which can kind of fast forward a lot of the risks here? How do you see that?
No, of course, that possibility, exists. And then, I didn't talk about the whole of last year. I think last year we went through, as a sector, fairly large number of sleepless nights. Last year, for example, there would be days when we wouldn't be sure at about 1 o'clock in the afternoon whether this institution meets its commitment or doesn't meet. It was crossed fingers. And it's not just one institution, multiple, and not just one category, multiple of them. But we survived. But I think last year what helped more than anything else was liquidity. Yeah. The problems were threefold, I think, last year. And this is before COVID, really. The problems last year were threefold. I think one was liquidity, which was largely from ALM mismatches. I think the second was solvency, which was primarily from investments in or lending to illiquid assets, real estate, and so on and so forth. And the third one, which really sprung a big surprise last year, was governance, really. Yeah. So problems were due to all three, really. I think we sort of tackled the liquidity problem to a large extent. We were in the process of probably tackling the solvency and the governance problem when I think COVID hit. But that's why COVID is so very scary. We already are sitting on all of these issues, and we are getting into a very unknown scenario out there. And you're a leveraged institution.
Let me bring Navneet and you to kind of do a tete-a-tete. A huge segment or constituency for the financial market are savers. And savers have had a bad deal in India because at a macroeconomic level, inflation is low and they've been squeezed out of their interest rates. Savings anyway has come down. You spoke about leveraging by consumers. Now you add to it a credit risk factor. So to keep both the financial system and markets going, what are the options for savers? Navneet?
No, I think savings will have to be rebuilt. So over the last 5 or 7 years, because the real income growth has been muted, people have been maybe eating out of reserves or maybe saving less from their incremental income and taking more leverage. And for a variety of these reasons, the savings rates have fallen. Household savings have come down from 25, 26 to now 16, 17%. The financial savings within that have been around like 8, 9% or so, which is barely enough to meet the government plus central plus the state government and plus the PSU borrowings. So I mean, we'll have to rebuild the savings, and that's why I mentioned earlier that this will hit the discretionary consumption. But interestingly, it's not about people spend less money and save more. Savings normally are kind of positively correlated with the income growth. So we need higher income. We need to get the investment cycle back. People get more jobs, higher incomes, they consume more, and then they save more. And over the next few years, hopefully, I think we should get there. Last few years have been no income growth and a fall in savings, which have to get corrected. And given our investment needs, I mean, we'll have to have a much higher level of savings in the country, and a larger proportion of that have to go to the financial markets. We have severe shortage of risk capital, and that's why I briefly mentioned about that idea of maybe a sovereign wealth fund, just to get a multiplier effect that the risk capital that we need is very limited in India from domestic sources, because large part of financial savings are also into bank deposits, postal savings, RBI bonds, etc., and maybe the debt funds. You need some bit of risk capital, because these new age innovations, I think if you want India to be that hotbed and want to create a Silicon Valley here, then I think remaining completely dependent on foreign capital, I think is better. We also have some bit of domestic capital there.
I'm going to take that question to you, Deepak.
Very valid. You know, just probably I'll come in. You know, normally when there is a crisis, yeah, and that crisis impacts the economy, the first tendency is the borrowers. Yeah, people forget that the underlying foundation of the financial system actually is savers. And the saver is as important as the borrower. And in your hope to protect the borrower, when you weaken the intermediary, you're actually weakening the poor saver. You know, and back again, when you're cutting interest rates down, real interest rates down, or you're reducing, you know, the weakness of the financial intermediaries, in effect, you are actually impacting the saver.
More than the saver, I would say that. Sorry, go ahead.
No, finish your point, Naveed. I wanted to go back to Deepak on this comment. Finish your point.
No. So I mean, there's a lot of debate on the whole FX reserve sovereign wealth fund, because India's reserves are basically, it's a foreign investments where you have to pay back. I mean, it's not earned through higher exports. But I think the level at which we have got, I think we need to think hard about it.
So, Deepak, and I'm glad to see Anand still there. I'm going to raise an ideological question to him. So, Deepak, does that mean, and Naveed made a point that India's headroom on fiscal is limited. We all know the factors behind it. We don't know the cost of COVID and what it can do. So, do you see interest rates spiking, or just the sheer lack of demand for that kind of credit is going to let it keep subdued? That's my question to you. If you can briefly answer it, I want to ask Nags Anand an ideological question.
I'd say short-term visibility poor, so very difficult to gauge. I think long-term, given the fiscal situation, I'd expect interest rates to undoubtedly go up. Undoubtedly.
And that's important for the audience. That's important facet. I just wanted to get the banker to say that. And therefore, when you look at the world, and this is not a challenge unique to India, this fight between capital users and capital savers. What is a fair reward between capital users and capital savers? Is COVID going to help? I mean, you made the point about the equation between man and machine, which is all the productivity gains have come from automation, technology, and so on, which has gone to the top 1% of innovators. Labor has been forgotten, so labor is going to come back and stake its claim. So that's the man versus machine fight. Are you going to see a similar kind of resolution come about between capital savers and users?
So, Vaidi, I think that's another profound question, no doubt about that. And I would say the answer would depend on whether labor is indeed able to get back its mojo. The same thing would apply to capital savers. So if we do indeed see a return to some sort of fundamentals. I mean, as I was listening to Navneet and Deepak speak, a friend of mine had just shared an article in Reuters written by Edward Chancellor titled "The Wall Street in Wonderland." I think you should, all the participants should read it. So the important point is, if labor class as a whole is able to reassert its rights, then it would automatically spill over into capital savers, i.e. pension funds, insurance companies, retirees, etc. will also be getting their due share, of because capital will begin to be priced properly. What has happened in the last 20 years especially, but definitely it has been in the making for the last 40 years, is that pricing of capital, pricing of risk has become completely rendered meaningless by central bank action. So your question is, it's a very valid one, because at some stage there will be a revolt by savers, and Deepak correctly put it. Foundation for all lending and borrowing is eventually the household savings and the underlying foundations of people being thrifty. So, so whether it comes back or not, my suspicion, if you ask me, is only a hunch. I have no basis to predict this. My hunch is that in this decade, we will witness the return of labor pricing power and the return of the voice of the savers as opposed to purely leverage holders.
In fact, on that savers, if the real rates remain low for an extended period, I won't be surprised if you again see interest emerging in real estate. This is a very contrarian view I have. If rates remain at these 3 or 4%, and if there is a correction in real estate prices, if both happen together, and the fall in mortgage rates, all three put together, is a possibility that some bit of interest comes in real estate. In Indian context.
So long as real estate remains unreal estate, I don't think any consumer interest is going to come